All right, if you've ever tried to swing trade, you know the feeling, right? You find a strategy, it works like a charm for a few weeks, and then boom, it just falls apart. It's incredibly frustrating, and it's why so many traders burn out. But what if the problem isn't your strategy at all? What if it's about when you're using it? Well, today, we're going to break down a rules-based system designed to fix that exact problem. So let's just start with that big, looming question. Why does this keep happening? Why do these awesome strategies seem to just expire? The truth is, it's rarely because the strategy itself is broken. It's because the market's personality changed, and the strategy didn't. And that's the nut we're going to crack today. And this quote just nails it. This is the heart of the issue. The market isn't this one static thing. It has moods, it has different environments. Trying to use a trend-following strategy when the market is just chopping sideways, it's like trying to surf during a tsunami. It's just not going to end well. So what's the fix? Well, the solution is actually pretty simple in concept, but it does take discipline. We have to stop trying to force our favorite setup onto the market. Instead, we learn to read the room. We figure out the market's current mood, and then we pick the right tool for that specific job. We learn to adapt. Okay, so how in the world do we actually decode the market's mood? We can't just rely on a gut feeling. That's a recipe for disaster. We need a clear, objective, rules-based system that tells us, yes, the market is trending, or no, it's just churning around. The technical term for this idea is the market regime. Just think of it as the market's underlying personality at any given time. And for our purposes, we're going to boil it down to two main personalities. A trend regime, where prices are making a clear move up or down, and a range regime, where prices are basically stuck in the mud, bouncing between two levels. Okay, so here's how we make this dead simple and totally objective. It's a two-filter checklist. First up, trend bias. We look to see if the 50-day moving average is above the 200-day. If it is, that tells us the long-term wind is at our back. Second, trend strength. We use an indicator called the ADX. If it's reading above 20, that suggests the trend has some real juice behind it. Now here's the key. If both of those conditions are true, bam, we are in a trend regime. If either one is false, we default to a range regime. Simple as that. This one checklist tells us which playbook to open. So let's dive into our first playbook. And remember, we only use this one when our checklist gives us the green light for a trend regime. We call this riding the wave, because that's literally what we're trying to do. Just hop on a move that's already in progress. All right, our entry has three very specific rules. First, we don't chase. We wait for the price to take a little breather and pull back to a support area, like the 20 or 50 period exponential moving average. Second, we glance at the RSI. We want to see it above 40. Why? This is our little safety check. It helps make sure we're buying a dip in an uptrend, not trying to catch a falling knife. And finally, our trigger to get in is a solid price close back above that moving average. That's our signal that the buyers are stepping back in. Now look, no trade is ever a guarantee, so we have to have a safety net. For this strategy, our stop loss goes right below the most recent little bottom of that pullback, what traders call the swing low. And to make it even smarter, we can use the average true range, or ATR, to measure volatility. Placing our stop 1.5 times the ATR below our entry just gives the trade a little bit of breathing room. And now for the best part, getting paid. Here's how we do it. When the trade moves in our favor by the same amount we risked, traders call that 1R. We sell a piece of our position. This is huge. It takes the stress off. Then we sell a little more at 2R. After that, we let the rest of the position run, trailing our stop loss up. This way, we lock in our profits, but still leave the door open for one of those massive home run trends. Okay, so what about when our checklist says, nope, not a trend? Well, we don't just sit on our hands. We switch playbooks entirely. This is our strategy for when the market is in a range regime, and we call it the rubber band. The whole idea here is completely different. We're not trying to follow a move. We're betting on the price getting overstretched and snapping back to the average. The entry logic here is the total opposite of our trend strategy. First, we're actively looking for price to get stretched way out, like a rubber band. Price touching or even closing below the lower Bollinger Band is our first signal. Second, we want to see the RSI dip below 30. This confirms that things might be getting a little oversold. And our trigger? It's a close back inside the Bollinger Band. That's the signal that the rubber band might be starting to snap back. Now, the biggest danger in a range trade is that the range suddenly breaks and the price just takes off against you. So our safety net, our stop loss, needs to be a little wider. we place it at 2 times the average true range below our entry. This helps us avoid getting shaken out by noise, but still protects us from a sharp, sudden breakout to the downside. And the exits here are also totally different. Unlike the trend strategy where we let our winners run, this is all about defined targets. The primary goal is to catch that snap back to the mean, which is basically the middle Bollinger Band. That's our highest probability target. So that's where we take our profits. Simple and clean. So now we have our 2 playbooks. We know what to do in a trend, and we know what to do in a range. But having the right play is only half the battle. The other half, the part that really separates the pros, is the discipline and the hard and fast rules that protect your money. So let's just quickly put these side by side one more time. With riding the wave, our core belief is that momentum will continue. With the rubber band, our core belief is that the price has gone too far and will revert back. They are fundamentally opposite mindsets. And that's exactly why you can never, ever get them mixed up. Now I need you to really focus on this next part. This number right here, this might be the single most important rule in all of trading. This is the absolute maximum percentage of your entire account that you risk on any one trade. Whether you choose 0.5% or 1%, this one rule is what prevents a single bad trade from wrecking your account. It is the bedrock of survival. Okay, let's talk about the big landmines you have to avoid. First, and I mean this, never, ever trade a pullback strategy without running that regime check first. It's like flying blind. Second, always factor in volatility. If the market is choppy, your position size has to be smaller to keep your risk at that 1% max. And third, just do yourself a favor and stay on the sidelines during major news events. It's not trading, it's gambling. And finally, here's a rule to protect you from your own worst enemy, yourself. It's so simple. After 2 losing trades in a row, you stop. You just stop. Get up, walk away, clear your head. This one little rule is a circuit breaker for what's known as revenge trading, that desperate emotional need to win your money back right away, which, let's be honest, almost always leads to even bigger losses. So I'm going to leave you with this question to really think about. Take a hard look at your own trading. Is it built on hoping the market will do what you want it to do? Or is it a system with clear rules that's actually built to adapt to whatever the market decides to give you? Because the answer to that question, well, that's the real key to consistency.